Good morning. My name is James Collins. I'm the Senior Director of Business Development here at CSBA. I will be helping moderate today's webinar session with our partner Foster and Foster. Today's session will focus on post-employment strategic options from an actuary's perspective, with an in-depth knowledge covering basic terms, benefit design components, funding strategies, and Governmental Accounting Standards Board 75 review. Some quick footnotes before we get started. As a reminder, we'll be recording today's session, and everyone will receive a link to the recording for their future reference if needed. If you have any questions for our panelists, please submit using the Q&A button, not the chat function, please. We will go through all your questions at the end of the webinar. If you have any questions at the close of today's webinar that weren't addressed during the webinar, you can also email us at csba@csba.org. At this time, I would like to introduce our presenter for today's discussion, Drew Ballard. Drew Ballard is a senior consulting actuary from Foster and Foster. And at this time, I will turn it over to you, Drew.
Okay. Thank you, James. Yeah, just quick intro. James mentioned my name is Drew Ballard. I'm a actuary with Foster and Foster. We do a lot of work across the country, but also within the state of California, which is where I'm located. I manage our California-based consulting team. We work with public retirement systems across the state, pension and OPEB related. You may be familiar with Foster and Foster. You may be familiar. We actually merged and acquired with a Dempsey Villager Associates, DFA, last January 1st, 2024. And they may have been your actuary for OPEB related and GASB 75 related valuations at that time. So you may be familiar with that name as well. As we've transitioned to Foster and Foster for that group, with working with a lot of school districts across the state. Today, we're going to go over OPEB kind of in depth. There's a lot of material to cover, some of it introductory, some of it a little bit more, what I'd say OPEB 101 and OPEB 201. And really my focus here is on the fundamentals and considerations from my perspective, right? From an actuarial perspective in producing this report. Whenever we're doing, a educational webinar, that's kind of the purpose here, right? To educate stakeholders on what OPEB is, how to manage it, considerations to think about with your group. And I'm hopeful that by the end of this webinar, that you basically leave here saying, oh, I learned something, or I enhanced my knowledge about that topic that. Honestly, when you talk about OPEB, you probably deal with it once or twice a year with all the other activities that you're doing. So I'm hopeful that when you leave here, things make a little bit more sense, or you're able to leave with questions or things to think about of how to manage your OPEB liability or your group going forward. Or if you don't have one, consider that in the future. So just kind of quickly going through our agenda, which James kind of touched on. I'm just going to kind of introduce OPEB, the concept behind it, what it really stands for, what it entails. I'm going to go over some basic actuarial terms. So like I said, if you're getting a GASB 75 report or an OPEB report once a year, you see a lot of numbers in there. You see some terms. I kind of want to just familiarize everyone with what those terms mean. And then we'll talk about, more in-depth things within, what are the benefits that are provided, what components, strategies do you have in creating those benefits or amending those benefits. I'm going to talk about funding strategies, which is, may or may not be something that your agency is interested in, but, something that a lot of folks do pay attention to across the state, especially in California. It's very common. We'll talk about GASB 75 specifically, which is really the accounting compliance you're required to record a liability on your financial statements. And then we'll kind of wrap up with kind of key considerations looking forward and best practices that are used that we see across our client base. As James mentioned, please, as we go along, if I'm going over certain information and you do have a question regarding that, please drop that in the Q&A. We will try to answer them possibly as we go along, or just answer them all at the end. I do have some polling questions as we go through this, just to kind of get a flavor across the room of how you're dealing with your OPEB setup now, if at all, just to kind of get some feedback and see what the popular answers are as we go through the presentation. So let's kind of dive into it now. So just an introduction to OPEB. What does OPEB stand for? Really, the acronym is Other Post-Employment Benefits. So really, the definition there is any retirement benefits that are provided other than pensions that are provided to your and retired employees. So really, it's post-retirement medical. And the most common type, obviously, is the medical healthcare benefits. That's predominantly what would create an OPEB, allowing retirees access to healthcare coverage um, as they enter their retirement phase, and then possibly even providing a premium subsidy during that retirement. Other ancillary benefits that you might see that are less common, but often come in within that OPEB package would be dental and vision coverage, life insurance coverage, sometimes even some long-term care, long-term disability. And, just kind of thinking about it from both the employee and the employer perspective, what is the significance of this OPEB benefit? Well, it's just another kind of layer, if you will, of any benefit package that is provided to your employees. And it, could be attractive benefit for which will assist with HR objectives such as recruiting and retention, right? A lot of times when people are hired, they aren't thinking about retirement, but as they continue on in their career and they understand that, oh, if I continue working here in retirement, I'll get a pension or I'll get a nice post-retirement medical package to help with my healthcare during retirement and my family's healthcare. That might be something that's attractive that is helpful to retain, some of those key employees as they continue down their career within your agency. And then from an employer perspective, we're talking about costs, right? If you're providing a benefit through retirement to your covered employees, there potentially could be some long-term liabilities there from an employer perspective that are important to understand, are important to manage. And what we're going to talk about today is kind of what those considerations can be, what options do you have, and proactively managing those liabilities that may arise, and they're again required to be included on your financial statements when you have an OPEB liability. So I'm going to kind of start off quickly into a polling question just to kind of see, where the room stands on OPEB. What's your familiarity with it? So which of the OPEB benefits does your agency currently offer to retirees? Is it medical only? Is it medical plus some of those ancillary benefits? Or at this point, are there no OPEB benefits that are provided within your group? I think we'll give a few moments just to get everybody's chance to cast their vote, and then I think we'll populate the results possibly. Okay, so and hopefully everybody can see that, but kind of the ones that voted, that actually looks like the ancillary benefits are included in the OPEB benefit package. So whether it's dental, vision, life, all of them, or some flavor of them, so not just medical only. Which honestly, I think that's great. It's probably less popular across the state. That I would usually see medical only, but we do have quite a few that do have dental vision as well. So that's great. Okay, so let's move forward. So I'm going to talk about just some basic terms. Again, this is something that you might not be familiar with when you get your actuarial reports or your GASB 75 reports. So I just kind of wanted to cover some of those terms that you might see as we go through the presentation, just to kind of develop an understanding of what are we doing when we're modeling the long-term obligations associated with OPEB. So a couple things to start out with: actuarial accrued liability, which is the GASB 75 term for total OPEB liability, is really, what are the benefits that have been attributed to past service that have been earned by your employees. So a couple examples. Let's just say I was hired at a school district, yesterday. I would essentially come in with no liability because I haven't earned any service. I haven't started accruing any benefit towards retirement. And as you continue to work, you are accruing that OPEB liability by earning service, getting closer to retirement, having a better chance of retiring from that agency and collecting a benefit. So if you kind of think about it, as a pie chart, you kind of start without any sliver, and as you continue to work, you gain slivers of that pie until you become a retiree, and at that point, all of your liabilities based on past service, right? You're no longer earning any accruals or any costs towards retirement. So you've completed that your service, and now your accrued liability um, is complete when you enter retirement from an active employee and gain that. So the normal cost, which is the next term there, is really what's the value of the benefits that are earned in the current year. When you see it on your GASB 75, it's service cost. That's really kind of the way I like to think about service cost or normal cost is, again, if I were hired today, what would we need to kind of set aside, or what would we expect the cost to be each year, assuming that everything is modeled, appropriately and assumptions hold true. What would that contribution or that cost need to be each year, such that when I retire, my OPEB benefit would be fully funded? And you could be thinking about this as pension as well, but really that you're accumulating enough, to pay for retirement through the active working career. So each kind of piece of normal cost is an individual year, is a piece of that pie throughout the working career to come up with that total liability at retirement. Discount rate. This is probably something you see a lot if you're familiar with GASB 75, which is really what rate does the actuary need to use to develop the liability. And when I say the liability, what we're really trying to do is, for those benefits that are provided to your retirees, right? Those are projected cash flows in the future. If you think about time value of money, right? If you're going to, obligated to pay those benefits down the road, those cash flows, if we discount them back to today at a certain rate, that's how we come up with today's liability, to use to calculate that total OPEB liability or that present value of benefits. I'll talk about the discount rate quite a bit as we go forward, and how it might change based on your specific situation with GASB 75, but really just thinking about it's discounting future benefit cash flows to today to assign that value. Value of assets, actuarial value of assets, that could be, GASB 75 again requires that we use market value of assets, but you could use actuarial value of assets. It's just, what are the assets that are currently in the trust, if you have one, that are set aside to pay for those OPEB benefits. And then the unfunded liability, which is the GASB 75 term for net OPEB liability, is really just what's the difference between our liability and our assets, right? What's the difference between that to come up with the net, which would be the unfunded liability or the net OPEB liability. The other thing on this slide, just kind of important to understand, whenever an actuary is doing evaluation, we have several assumptions that we're using to model the future costs, right? Thinking about OPEB, and I'll talk about this a little bit more on the next slide. How do we expect premiums to change over time? When do we expect folks to retire, given that they're eligible? How much turnover do we expect within your group, year in, year out? What do we expect investment earnings to be? How long do we expect people to live to collect those benefits? So we're modeling that behavior to determine the liability associated with those contingent future events, if you will, of when those benefits will be paid and how long they'll be paid. A couple more terms just to kind of wrap up, just this introductory, just to make sure everybody kind of is understanding it, or, if you go back to your report of what these things mean. So actuarial cost method really is just a technique to allocate the present value of benefits over time. So I kind of talked about the pie, coming up with that normal cost. What we're really trying to do is allocate, what's the annual cost that is being earned as people are earning benefits and possibly becoming eligible to receive that future benefit. GASB 75 requires that we use the same, all actuaries use the same cost method for determining that for consistency and transparency in the reporting. Amortization period, if you do have an unfunded liability, is kind of akin to a home mortgage. What's our period that we are making payments to eliminate that unfunded liability, to fund from our current funded status to 100% funded. Actuarially determined contribution, is really just a systematic way of developing the recommended contributions by the employer based on a funding policy to pay for to set funds aside to pay for those OPEB benefits in the future. Um, there's a couple more, and this one's important: healthcare trend rate. This is specific really to OPEB and GASB 75, and I kind of mentioned it a second ago, but how do we expect premiums to change over time? So it's the projected rate of increase in healthcare costs. Whenever we're modeling the expected obligation in the future, depending on how the benefit is structured, we need to have a guess of how we expect those premiums to increase and change over time. And actuaries are constantly analyzing that and reviewing that and how those assumptions are used. Typically, what you would see is like a short term, next 5 years, we would expect higher increases, maybe 8, 7, 6%, and then kind of throughout the long term decreasing to a medical inflation rate of maybe 4%. That's kind of the typical assumption range you would see or setup you would see in an actuarial valuation. The last two are just kind of the funded status of the plan. What's the ratio of the assets to liabilities, right? And then I've talked about it, that actuarial accrued liability is synonymous to total OPEB liability, which you may be more familiar with from a GASB 75 term for what goes on the financial statements, and then obviously the net OPEB liability as well. So now that we've kind of gotten the actuarial stuff out of the way, if you will, we can focus on some of the more important things, or probably things that you in your role are thinking about or have dealt with in the past, and really designing the OPEB, managing the OPEB. So let's talk about some of the benefit design components that need to be discussed or have been discussed in establishing your current plan. And it's kind of just starting from the top here, what's the eligibility requirements? Dictating when folks would be eligible to receive that benefit. A lot of times, if you're providing pensions as well, it could be the same as the requirements to be eligible to retire and receive that pension. But a lot of times you'll see it where OPEB has specific agent eligibility requirements that may require longer service with your agency or an older age. So you really are able to design it such that you're setting the age and service requirements that need to be met in order for that future retiree even to be eligible to receive benefits in retirement, which you kind of have some latitude and some control over. One component that we see a lot is also what we call vesting provisions, where just for example, maybe it's a 20-year vesting schedule, so you need 10 years of service at your agency to become vested, and you're 50% vested at that time, and then earning into 100% vesting. That allows, a lot of times we think about it, right? We're providing a retirement benefit, not a vesting benefit. So those folks are rewarded by the longer service within the agency to vest into that full benefit provided. And you can also have some cost controlling mechanisms by using those vesting provisions. We've talked about benefit types a little bit in the introduction, medical, dental, vision coverage, but really talking about benefit levels as well here in a second. Obviously, prescription drug benefits, life insurance possibly included in the benefit package. And at the bottom, really, this is where we get into kind of, what's the cost to the agency versus the employee or the future retiree, and what are those cost sharing provisions that are employed within your OPEB plan. So a lot of times, we'll see a premium share arrangement. For example, it could be 100% employer. The employer, the agency, pays 100% of the premium in retirement, and the retiree is not required to pay anything. That would be obviously the most expensive to the employer. Or you could see some other level where the employer pays 80%, 60%. A lot of times you'll see it based on a percentage. The next bullet, sometimes you'll see it based on a cap. Okay, we're willing to contribute up to $500 per month to subsidize your healthcare premiums in retirement. 500, 600. This is where you really have, like I said, some of that control in creating what the benefit design is of how much the agency will contribute on behalf of the retiree during retirement, and then obviously the retiree would have to contribute or pay for the remainder of their premium based on those benefits that are provided at retirement. A couple other just kind of continuing on some of those benefit design components. So, I think one that's important, and a lot of times, I'm thinking about costs. I would imagine when you're setting up these plans, you're thinking about cost is okay. Let's say somebody retires and they're eligible for these benefits. How long are they going to remain eligible and get that benefit paid to them? And a lot of times you'll see it for life, right? Although other times we'll see it for a limited duration. Maybe it's for 10 years, maybe it's for 15 years. I've seen, people can get very creative here. I've seen it. Well, if you worked for, the district for 20 years, we'll pay your OPEB for 20 years. It can be tied to your actual service. And then one of the next bullet point, which is really a common consideration, common thing that is being employed through OPEB plans is coordinating it with Medicare, right? Premiums before age 65 and after age 65, once folks are eligible for Medicare, the premium level goes down significantly. So it might be that the OPEB is paid only until Medicare age, right, to help with the higher costs, or it could be that the benefit changes once you get to age 65. So you've got some components there with Medicare, or possibly even just how long that benefit will be provided to its retiree from when designing those benefit plans or those benefit designs. Another one, just on the next section here is, dependent coverage, right? A lot of times that retiree, it's not just for their retiree's life. The spouse might be eligible, or partner might be eligible to continue to receive those OPEB benefits as well after the retiree has become deceased as part of that package. Sometimes you see it where, okay, the retiree was getting X percent of premium, the spouse is going to get a percentage of that, or the cap is lower for the spouse. And these things are ways, that folks can control that cost and also provide the attractive benefits. So you're setting these different benefit components, and they need to be considered when you're coming up with an OPEB plan. So really, some of those considerations, I think that folks are thinking about when they're designing the benefit package, if you will, is kind of that balance between, okay, we've done some cost control, but we also want to provide competitive benefits to our retirees. So you've got that balance there between controlling that cost and the benefit level. Obviously, there's some considerations and being competitive, right? Depending on what your individual goals are, objectives are, is being competitive and providing a benefit level that might be comparable to your peers, and when trying to do some recruiting and retention, like I mentioned earlier. And then obviously there's always legal constraints or contractual constraints that need to be considered as well when developing those benefits for your future retirees. Okay, so on the polling question two, just as we've talked about benefit design, how is your agency set up right now to handle the retiree healthcare costs? So basically, does the agency pay 100% of the premiums? Does the retiree pay 100% but still have access to healthcare coverage, or somewhere in between? And you got a couple options there. I've always got a guess of where I think things will land, but it's always interesting to see the range, especially with the distribution when going through this with different audiences. Okay, so we've got basically looks like I thought it would be B, employer pays majority, retiree pays some, but we also have quite a few there where the employer is paying 100% of the premium. So the they're covering 100% of the costs, which obviously if from a retiree perspective, that's fantastic that you're getting that access. And then from an employer perspective, if you're on this webinar, we're going to talk about some of those the cost control mechanisms or possibly funding strategies to consider to think about those long-term obligations. So the next couple slides, I'm going to talk about uh, you know a concept that is sometimes difficult to understand, or sometimes even foreign to folks that aren't actuaries that deal with this once or twice a year. And it's this concept, a term that's called the implicit rate subsidy. You may have heard implied subsidy, implicit subsidy. So what I really want to do over the next two slides is hopefully just kind of introduce it, um, help folks understand what exactly this means if you hear it or you see that there's a liability associated with it. So it's one of the more challenging concepts specific to OPEB that we get feedback about is what exactly is this? So my goal here is just to kind of introduce it and hopefully help folks understand what exactly this concept is presenting or why it is included in the GASB 75. So here's what it really is. It's kind of we call it a hidden cost that occurs when you have a younger group, usually actives, healthier workers, right? And you have retirees that are typically older age and they're paying the same premium. So you aggregate the claims experience between those active employees that are younger and those retirees that are older, and you develop a blended premium that is charged whether it is you're younger or whether you're retired and close to Medicare age. So kind of going through, I'm going to talk about how it works. I'm going to give a simple numerical example, and on the next slide, I kind of have a graphical illustration that'll hopefully tie it all together. But how it works is, as you can imagine, retirees or people in general that are older typically have higher healthcare costs than your active younger employee group, right? So when premiums are set based on that pooled experience of that entire group of both actives and retirees, what we see is the retirees are paying that blended premium for the retirees is less than their actual expected cost, and active employees are paying more than what their expected cost is. So they're effectively what they're doing by that premium being more for active employees than their cost is they're subsidizing that retiree population due to the fact that there's a blended premium. So just simple numerical example, and these are completely made up, but hopefully somewhat reasonable. Let's think about an active employee who's age 35, and we say that their expected annual healthcare cost is $2,000. Okay, and then let's take somebody who's retired, they're age 60, haven't hit Medicare age yet, and we'll say their expected cost is 7,500 a year. Okay, so the way that this works in practice is those 35-year-olds, those 60-year-olds, their claims, their healthcare claims experience is aggregated and it's blended into a single premium across the entire population. So for my example, the blended premium for both the active employee and that retiree that's charged is $5,000 per year. Okay, so what the result is, you think about the retiree age 60. Okay, they cost $7,500. Well, we're only charging 5,000, so they're getting a $2,500 subsidy by paying the $5,000 premium when their actual cost was 7,500. So that's kind of the simple numerical example. And then going to the next slide is where I kind of try to bring this in visually of what creates this implicit subsidy. So if you think about it, folks are usually retiring, age 50, age 55, something like that. What we're trying to do is develop what's this little triangle here on the right side of the cost where that blended premium is less than the cost of the retirees, right? So in my example, age 60, $7,500, that $2,500, there's a liability there that the premium is not sufficient to cover the expected cost of the retiree. And the way that that is really being covered is the fact that the active employees, your younger population, is getting charged that same $5,000, the premium, and their actual cost is quite a bit lower. Younger folks typically tend to be healthier, don't go to the doctor as much, you know, so their claims is less. So that's really what the idea is. And what why do you care, right? Is the actuarial standards of practice require that this liability, this subsidy that's being created is included in your total OPEB liability for purposes of developing the GASB 75 liability. So, you know, I think there was one person in the pool that responded that the employee pays 100% of their premium, the retiree pays 100% of their premium, but they still get access. So at that point, you still have an OPEB liability, even though the employer is not paying any cash subsidy during retirement because this implicit rate subsidy still exists. So that's the liability impact. There's still an employer liability, even when the retiree is paying the full premium because of this concept. And again, if you've been working with OPEBs for several years, I think it was 2015 or so. Before that, it was not required to be included in GASB 45. There was no implicit subsidy required. Then all of a sudden, the standards of practice changed. Actuaries were required to include this as a liability, and depending on your structure and depending on your healthcare coverage, this could present a pretty significant portion of the OPEB liability. I've seen it, typically you see it's probably 15-ish%, but I've seen it go up, quite a bit for certain plans. So it's definitely something that is part of your overall liability typically. And it's something that also, like I said, a lot of folks say, what is this? How exactly does this work? So I'm hopeful that, it's required that we include it. And hopefully that little simple example was helpful in kind of understanding why the actuary talks about this and what it represents. So I'm going to move away from kind of the benefit design component and talk about strategies to manage this long-term liability. So I think the next polling question really asks, what your agency is doing here. But the way I see it, it's easy. It's the easiest to break it down into three different strategies. And across California, just speaking of, about OPEB in general, there's a lot of agencies that have set up a trust to actually dedicate current funds to pay future benefits. Outside of California, it's a lot less common. The most common strategy is the first one that we're going to go over, which is just the pay-as-you-go strategy, which basically means, okay, we're committing to paying a percentage of premium for our retirees or whatever that benefit design is. And as those premiums come due, we'll pay our portion of it each month, right? So you're just paying from your current resources as they come due. There's no pre-funding involved. There's no trust that's being where you've set up assets that are being invested to cover the future benefits. You're literally just paying those benefits as they become billed. That's a very common way of doing it. Really what a couple of things to think about with that strategy is you have the lower near-term costs, right? Because you're not setting aside any additional budget to pre-fund that liability. You're not dedicating some of your budget to a trust contribution, but you might have higher long-term costs because you're not generating any investment income to pay for those benefits. And I'll talk about that more in the future. And from a GASB 75 perspective, what GASB, the Accounting Standard Board, requires if you don't have a trust is when the actuary is developing your total OPEB liability, that discount rate we talked about, we're required to use a 20-year high-grade municipal bond index rate, which can vary quite a bit from year to year. Currently, I would say we're about 4.5%. Interest rates have been higher recently, but it was only probably 4 years ago where we were using 2.2%. So that could have a significant volatility an impact on the OPEB liability that's been being recorded on your financial statements. The next one is a common approach that we see, which is what we call partial pre-funding, okay, which is really in the middle, right, between pay-go and full funding, which is really, okay, we've established a trust. We may have put some seed money in there, call it $1 million, to invest to help cover this future obligation, but we don't have a formal funding policy. We haven't dedicated an annual contribution. We're kind of managing it as we go, doing ad hoc contributions. And, that's really balancing, between the current and future costs. So not deferring all the future costs to future generations, but setting aside some current funds in the budget to know, okay, we know we got this liability that's going to be, growing. We're promising our retirees benefits. We'd like to set aside some funds to be used in the future to help pay for those benefits. The GASB 75 has a special way of dealing with that I'll talk about a little bit more, where the discount rate might be between the municipal bond index and the expected rate of return on assets, which is really, takes me to the full pre-funding, which, whether you're in have pension with CalSTRS or CalPERS, or maybe are familiar with managing a pension, that's the full pre-funding is really the way that all pension funds are ran, which is you're contributing an actuarially determined contribution to a trust each year, and those benefits are paid for from the trust at retirement. So you're setting aside assets to fully fund future benefits based on that actuarial recommended contribution that I talked about before, contributing the normal cost, paying off the unfunded liability over 15 or 20 years. And what that results in, if we're talking about from a budgetary, component, there's a lot more volatility because you're dedicating these assets that you're expecting to earn certain returns each year. So the kind of the opposite of the pay-go, where you have high short-term costs, maybe even volatile short-term costs, but hopefully you're making money on the money that you're setting aside, right? And you're lowering your long-term liability by having assets, grow and be available to pay for those benefits in the future. So we're kind of going from, the less volatile approach, which will save you on your short-term budget, versus the more volatile approach, which will save you money long-term, depending on your preferences and your appetite for risk, and maybe even your budgetary constraints. I have a lot of clients who ask me, Drew, what would you do, or what do you recommend we do? And we're just the actuary looking at one component of your budget line item, right? We don't know what internal competing objectives you have based on where money needs to be funded. So I always say, the best I can do is show you, the math, and give you ideas and strategies, and show you the differences between those strategies. But I don't understand all those things that are happening internally. So really, just trying to educate and give you the best information that I can to help you make informed decisions. So obviously, we talked about the investment earnings. So GASB 75, kind of just, wrapping this section up. GASB 75, once you've set up that trust, that discount rate is tied to how much money we expect that trust to earn on the long term. I think I'll talk about some of the options available across the state, but typically you would expect to see that around 6%. I think CalPERS uses 6.8%. They've got a sophisticated investment portfolio. I think CalSTRS, I'm sure, is somewhere in the 6.5% to 7% range. So you would use a higher discount rate because you're expecting those assets that are being actively invested to make a better return long term than maybe your general fund. Okay, polling question 3. So I don't, not necessarily what you're doing today, but if you had to choose based on the information that if you were making the decision today, which approach that we just discussed would you prefer? The pay-go approach, the full pre-funding, somewhere in between, or I put on there you'd want to do crunch some numbers and do some more analysis to help inform that decision. We'll see in a second here how the answers shake out, but I always think there's an interesting, kind of just to get people's feedback on, are you looking at this from a compliance perspective? Okay, we provide the benefit, we need to comply with it, we need the GASB 75, we want to continue doing PAYGO to reduce our short-term impact, or we want to actively manage this. Okay, so this is kind of exactly what I would have expected to see. And personally, I think that B, makes a lot of sense because you're using that balanced approach, which is somewhere in between, right? Okay, we want to monitor it, we want to actively manage it, but we don't know how things will change year to year within our budget. How will healthcare costs change, right? So you give yourself a little bit more flexibility with that. And honestly, that's kind of, if I was in your shoes, I probably would have picked that, just because it offers the flexibility, which is one of the nice things about OPEB in the funding, is that you do have, based on what's best for your agency, you have that flexibility within within the decisions. So just quickly, just talking about kind of leaning on that investment component and that funding strategy component. Whenever if you've seen an actuary present at a continuing education or seminars or something, this is something that's popular that you would see is kind of the fundamental equation of pensions or OPEBs or any retirement benefit system that will always really hold true, which is this C plus I equals B plus E. What it means is that the contributions that are made from your funds plus the investment income that you earned on those assets, right, will pay for the benefits and the expenses that are required based on operating an OPEB plan. So the reason I bring this up is, ideally what we would see over a long term is keep contributions low, earn a bunch of money on the assets that you've produced to pay strong benefits. Is this realistic? Maybe not, but it does show the idea that if you don't have a Section 115 trust set up, that I would be zero, right? And your contributions to be PAYGO would be the same as the benefits plus the expenses. So by establishing that Section 115 trust to set aside funds, if your budget allows for it, you're going to produce some investment earnings that will help pay for those benefits in the future, which will lower that long-term C, or the long-term contributions that are required to pay those benefits. I just kind of wanted to show that again, illustratively. So what funding vehicles are available, for you if you wanted to go down this direction, or if you already have OPEB trust, it's irrevocable. And why is that important? So once you set up this trust, it's dedicated to pay OPEB benefits, right? It's earmarked for OPEB benefits. It must be used to pay retiree medical benefits to your participants. So, there's active management in there, making sure that you're using the funds when at the appropriate time to pay for benefits. But, it is dedicated and required to be used to pay OPEB benefits in the future. You can't change your mind 2 years down the road and switch gears and use it to build a new gym or something like that. One of the things that I talked about was it allows you to use a higher discount rate under GASB 75, which could help manage that OPEB liability on the financial statement compared to the long-term bond index rate. And then I talked about Section 115 trust. That's kind of what for IRS Section 115, it's only available. It's a government-only trust. You create tax-exempt investment earnings, so there's some advantages there. And then, nowadays there's a lot of folks out there that are offering these trusts with different investment objectives. So, for example, CalPERS, the CRBT, which is the California Employers Retirement Benefit Trust, they have 3 different portfolios that you get to choose. Do you want to be aggressive? Do you want to be a little more conservative? Somewhere in the middle. PARS, I think, gives you 5 options. So, there's a lot of providers out there that can give you different strategic asset allocations based on your own objectives. If you wanted to go down the road of establishing a 115 trust to earmark for OPEB benefits, or if you already have one, things have changed over time. and there's more providers out there than there used to be. So let's kind of keep moving. I know we're covering a lot of information at once. I hope that it's informative, but I kind of want to tie everything together here as we wrap up. So, GASB 75, you probably are familiar with it if you're on this webinar. So just kind of a quick overview. The purpose is obviously the accounting perspective, right? Governmental Accounting Standards Board. So the accounting and financial reporting for your OPEB liability. Like I said, if you've been around working with your agency or working with OPEB for a long time, this used to be GASB 45. Back in 2017, there was a major overhaul to the financial reporting for OPEB from 45 to 75. And really with I guess the goal, the objective from GASB there was to increase the transparency of the OPEB obligations. But I can guarantee you, if you were working with 45 and 75, just like me as an actuary, it's created more work. It's created more difficulty in what needs to be reported within your financial statements, and a little bit more attention to the OPEB, if you will. So some of the key requirements, you're required to recognize your total OPEB liability, which we've talked about at length, on your balance sheet. The note disclosures that are required to go into your annual financial statements are way more detailed than they used to be. Journal entries, it's something we help out with a lot as well. So the required supplementary information, like I said, it's really, there's just so much more that goes in under GASB 75 than they're used to under GASB 45. GASB 45, I think, used to be just a few pages. And then one thing that GASB 75, it does require that the actuary do evaluation every 2 years. So when I say, well, we're doing evaluation, we're getting, if you work with the actuary, you're getting new data for your active and retiree group. We're looking at how premiums have changed since the last valuation. We're updating our model to redetermine that total OPEB liability. And GASB 75 requires that we're doing that at least once every 2 years to be actively monitoring it and seeing how things have changed since that previous valuation, to report the updated total OPEB liability. Okay, we've got another polling question. So what is your biggest concern about OPEB obligations for your agency? I got a couple options there. Size of the liability on the balance sheet, impact on credit rating, healthcare costs making benefits unaffordable, or lack of understanding among your leadership. One of the ones I do mention there with the credit rating, this is something that folks have, if your OPEB liability has grown, how can we reduce that? That's one thing that we've talked about with possibly setting up that 115 trust if your budget allows for it, which could have an overnight impact on reducing that liability by earmarking current assets with future returns to pay for those benefits. So we'll see where we shake out here, just to kind of see, what your individual agencies are thinking about as you tackle OPEB. Okay, looks like the most common was not surprising, healthcare costs evolving over time, premiums changing, making those benefits that are provided, tough to manage. And thinking about poll question 2, which was, what's the benefit structure? I think most of the group was the employer pays 100% of it or more than half. So as healthcare costs go up, that's borne by your agency as those continue to rise. So that makes sense. Same for employees, right? Retirees, those healthcare goes up, their contribution is going up as well, making it challenging for them to continue to pay their share of the premiums. I think, hopefully we'll be, I think we're getting down to the last couple sections here. So I'll try to, I know your attention spans could probably last so long with actuaries. So I'll try to wrap up here, but there are a couple of things I do want to talk about, regarding GASB 75 that are just key concepts to keep in mind. I've talked a lot about discount rate determination, right? Do you use the long-term expected return, or if you're not funding the municipal bond rate, which has a lot of volatility, went from 2.2% to 5.2% in like a 4-year time span, which has significant impact on your OPEB liability, your OPEB expense recognition. Um, so, that's commonly thought about incorrectly, I think, around our clients, which really what we're trying to do with the OPEB expense is really a GASB 75 term that is, what is the change in the OPEB liability from year to year. And we create deferred inflows and outflows for certain changes. So, one of them, if we change assumptions, we're spreading that over a certain number of years as it's recognized in your expense. Actual versus expected experience. When were folks retiring? How much did premiums change? That changes the liability. So we amortize that over certain years as well. And really, what I don't want you to think about OPEB expenses. It's not what your cash contributions were, right? So GASB 75 is really trying to reconcile the changes in OPEB liability from year to year, not what you were contributing based, to pay for those benefits, because GASB 75 is based on accrual-based accounting. We've talked about net OPEB liability that goes on your financial statements, which is just your total liability minus your assets, GASB 75 term fiduciary net position. So, just some key considerations. I think this is the last section, key considerations and best practices, kind of tying what we've gone over together, and also thinking about, okay, from the sponsor's perspective, right? You're trying to manage a long-term obligation. Let's talk about some of those key considerations. So financial impact, balance sheet, right? What are the balance sheet impacts? Talked about bond ratings a little bit. Sometimes whether it's pension liability or OPEB liability could be a sore spot on those reviews from bond rating agencies. So how are we able to navigate that to improve our bond rating? And then budgetary planning, right? If you have a trust, or even if you don't have a trust, right? How do we expect that pay-go to change over time? Typically, you would see an actuary will provide some longer term projection, 10 years, to show you how we expect your out-of-pocket expenses to be just to pay your percentage of the premium or the benefit that's provided. So if you have your GASB 75 or your actuarial evaluation, you can look in there. If it's not in there, you can talk to your actuary and say, hey, could I get a 20-year projection, 10-year projection, so you can understand how we expect things to evolve over time, as we expect premiums to increase, as we expect people, more and more people to retire in the short term, depending on your composition. So some budgetary planning, whether you have a trust or not there. I've talked a lot about sustainability, right? So, what's the long-term effect of the OPEB? How can you manage it? What are some of the healthcare cost containment strategies? The sharing with retirees, creating a cap. That's where you kind of have those benefit design components where you can kind of strategically navigate some of those waters to be sustainable over the long term for you, without maybe losing some of that benefit adequacy that we talked about in providing that benefit to your retirees. So you've got some options to consider there as you move forward. And then obviously, whenever you're providing a benefit package, especially in retirement to your group, there's some risks involved there. One of them was the last polling question, right? Healthcare trend. How will premiums change? How will that change our costs? How will that change our budget? Investment risk. If you have a 115 trust, we expect to earn 6% per year. What if the market, goes down 5%? How does that change our short-term budget impact or our long-term strategy? So you're navigating some of these risks, and should be conversations you're having with your actuaries when you're doing the GASB 75 each year, depending on your specific situation. I put demographic risk. One of them that has gotten a lot of attention recently is people are living longer and longer. Those benefits that were promised, right, are being paid longer, adding to that long-term liability. So those are some of the things that just to be considering as you're strategically trying to manage your OPEB liability going forward. And then kind of here's some best practices. that we see in practice as actuaries, dealing with our clients, working with our clients. Obviously, GASB 75 requires that we do valuations every 2 years, but monitoring the way that changes, the liabilities changes when actuaries are doing those valuations, we're looking at the experience. How do we expect premiums to change? When do we expect folks to retire? Updating those assumptions as needed. So we're monitoring that ourselves, and reporting that to you when we do the valuations. If you don't have a funding policy and you have assets that are established or you're considering it, one thing that might be a good practice is to actually have something formal in place, right? To establish targets of what you want to reach over a specified time period, or how much budget you think can be earmarked to pay for those OPEB benefits. You've seen some of the advantages. We've talked about some of the advantage of doing so throughout this webinar. Obviously, if your budget allows for it, that's what we don't know. So determining that strategy. Benefit design, we've gone over a lot of those components today, balancing that cost control with the benefits that are provided to your group. Then obviously considering, that Medicare integration, when people become eligible for Medicare and they're receiving that Medicare benefit when premiums drop. How should we manage our OPEB benefit that is provided to our group, maybe separately for pre-65 and post-65? A lot of times I think that gets overlooked, and the benefit continues to be higher for the post-65 group than maybe it needs to be. So something just to consider, again, thinking about best practices. And then the last thing I have here is communication. A lot of the folks we work with that are on the HR side or the finance side, we're working directly with them, but then you've got another board that to report to. So just being transparent, trying to report that to all the stakeholders within your group, and trying to explain what, kind of things we've gone over to here of what the OPEB is, what benefits are currently provided to your retirees, what do these obligations look like long term, and thinking about strategies to manage that. I think that is okay. So I've got a summary slide here, just everything that we've kind of talked about. We're coming up on an hour, so I'll kind of run through this. But to summarize the things that I've gone over that I want you to hopefully gain from this and think about as you leave, and think about, a lot of you probably operate on a June 30 fiscal year. Coming up in a couple months, what GASB 75 reports will be coming out. Things to think about as you're getting those reports. OPEB can represent a significant long-term obligations for you as the employer. Understanding some of the concepts we've gone over is helpful and essential to manage these liabilities. Your benefit design as you structure it, which we've talked about a lot, can directly impact not only your liability but how it changes over time. You have funding strategies available to deal with those short-term and long-term implications. GASB 75, which is what you're probably most familiar with, provides transparency, but also creates challenges in the financial statement. Like I said, it's evolved over time to something that requires more attention. And then lastly, just managing this proactively is key to sustaining the costs and the way that you're strategically managing something that might not get much attention, that might deserve a decent amount of attention in your OPEB liabilities. I think I did have one wrap-up question, if we don't mind, here. And this is just kind of after everything we've gone through, what are you going to do next? What's your most likely next step regarding OPEB? You're going to go look at your recent actuarial evaluation, going to work with maybe your leadership to discuss it, review your current benefits, explore funding options, or thanks, Drew, for the information. We'll keep doing what we've been doing, and we'll wait for this results, and then I'll turn it over to James. See if we have any questions.
Yeah, there is a question as that poll
Okay.
through. It is in our Q&A, so I'll give it a couple more seconds here as folks do the polling. But there is a question in the Q&A.
Great. Okay, so kind of good distribution here. I like, kind of C and D, right? Let's go take a look at what we're providing. Let's go take a look at options that we have to mitigate some of this risk. So great answers. I think, I appreciate you kind of joining along throughout some of the questions just to kind of get feedback on. It's always nice to know what people around the state, around some of our client base. So, what are you thinking about? Because a lot of times, like I said, we only talk once a year to produce the numbers. So it's nice to know kind of what strategies and what you guys are doing on your end as well. James?
All right, yeah, we do have a question, Drew. Our district has a ref. I'm not even gonna try to pronounce that word right now. But anyways, our district has OPEB funds in the district Fund 20. What are the advantages and disadvantages of leaving these funds in Fund 20 or invest in a trust?
Am I able to see?
Yeah, just go down to the
Okay.
Q&A.
Okay.
Yep, you see it?
Yeah, I'm not super familiar with Fund 20 and what exactly that means. I think that it seems like they're earmarked to help, fund
Hmm.
benefits as they come due. A lot of times, I guess what I would say the advantages there is you have internal control,
Hmm.
right? They're in those funds, but they're available when needed, right? That would be an advantage is that, okay, let's see how things evolve. Oh, budget's changed. We need to pull some from here, or the OPEB costs got a little more. We've got some available. I would say the disadvantages, my guess is that Fund 20 isn't being invested aggressively, where if you're expecting it there to be long term, it's not going to produce the same amount of returns it would if
Hmm.
you were, it's kind of like you're looking at a short term versus long term,
Hmm.
uh, pros and cons there. So short term gives you a little bit more control rather than setting it aside to use it in 10, 15 years from now. But
Hmm.
you're also probably leaving some money on the table by not, having some equity exposure possibly. It's probably more of a short term, like a bond obligation type thing.
Got it. That was our only Q&A. Is there any type of questions that's not in our Q&A that typically comes up that maybe you haven't addressed? I know you addressed a lot today, but just want to make sure that we're covering all the bases here.
Trying to think of maybe feedback I've gotten. Nothing. There weren't ones that I expected to get. I guess I think it depends on what the focus is, and I think that just like looking at some of the polling questions, right? Oh, we're
Yeah.
going to go back and look things a little deeper. That
Yeah.
might create questions of what latitude do we have to do things differently than we have in the past.
I have a question.
Sure.
So obviously our partnership, we do quite well together and we market together, but from a market perspective, I mean, we CSBA has worked long term with a previous partner, and now obviously we work with Foster and Foster. So I guess what benefits do you guys kind of bring in that merger that you guys had that maybe you didn't see from the previous, or from a cost perspective? Like, what does that typical process look like now that you guys have acquired the previous company?
Yeah, I mean that's a good question, and it's honestly a question we get a lot because there's a lot of actuaries that are available to produce this work, right?
Mhm.
I think one thing that we like to market or focus on is, you know, actuaries go through a series of examinations to learn the math. Most actuaries can do the math. It's about, the consulting side of things, working as a partnership with the agency
Mhm.
to, you know, do some of the things we did today, educate, right? We don't want it just to be, here's your numbers, let us know if you
Right.
need anything. It's more of a communication, a conversation. How can we actively manage this important obligation, think about different strategies, possibly do longer term projections or do some modeling
Mhm.
to assist with that informed decision making. So um, that's one thing I think that we try to pride ourselves on as at Foster and Foster is doing things like this. We have other folks that travel across the country going to trustee education sessions where we're not getting paid to be there. We're doing that on our own dime and trying to educate those folks that are monitoring these plans and making decisions for these plans, which affect real people, right? Affect future retirees. Um,
Got it. Got it.
so
Perfect answer. I appreciate it. Well, I don't see any other questions. Let's give it maybe another 10 seconds seconds if there's anything that pops up, but if not, we'll wrap up. I really appreciate your time today.
Yeah, was a pleasure, and I'm hopeful that the audience, even though we can't see them, is leaving here with things to think about, and also thinking, okay, I know a little bit more about what this OPEB stands for and what we can do to navigate those challenges.
Yeah, I learned a lot today as well. I mean, I've seen it from a CSBA perspective, but really kind of go into the weeds, if you will, makes a lot more sense, and we understand the importance of it as well. So, but anyhow, thank you for everyone for joining us today, and thank you for our presenter today as well, Drew. We really appreciate your time. CSBA is dedicated to providing up-to-date resources to our school board members. To view our recent webinars, be sure to check out our YouTube page at youtube.com/CSBA video. That's VIDEO. And if you are interested in attending future CSBA webinars, please go to our website at www.csba.org/webinars to register for upcoming webinars. Many thanks to you again, Drew. And with that, we'll see you guys next time. Have a good rest of your day.
Thanks, James. Thanks, everybody.